In this video, I'm going to do a similar example to exercise 1111, and I'm going to go beyond the calculations and explain a little bit more some of the conceptual stuff that you'll also have to know for the exam. The starting point here is we've got a company that's a regional chain of health clubs. The managers of the club have the authority to make investments, but they're evaluated largely based on ROI, which is also return on investment. The Springfield Club just reported the following results for the past year. Sales of 900,000, net operating income of 31,500, and average operating assets of 100,000. The starting point is simply to calculate return on investment, again also known as ROI, and we can do that as a combination of margin and turnover. So I'm going to start out with margin, which you should know is net operating income divided by sales. We're given those numbers up above. So that's going to be 31,500 divided by 900,000. And margin is converted to a percentage. Important to know which ones are a percentage, which ones are a number of times. Margin in this example is 3.5%. So that's saying of the sales dollars, 3.5% of it is net operating income. The next calculation we're going to do is turnover. Turnover is sales divided by average operating assets. Again, pulling our information from above at the current starting point, sales is 900,000 divided by average operating assets of 100,000. This one is not a percentage, so we're not converting it or moving the decimal point over. This is 9, and in fact, it's 9 times. So what we can say here is on average, our operating assets, those things that help us produce and deliver products and services, delivered 9 times the amount of sales dollars, which is a good thing, at least on the surface here. So how do we put this together to eventually get to ROI? ROI is also known as the combination of margin and turnover. So we'll take our margin of 3.5% times our turnover of 9, and that's going to give us a return on investment percentage of 31.50%. Now we did this as a combination of margin and turnover. We could have also calculated ROI directly, and pulling my numbers here from my other formulas, ROI directly would be net operating income, which I could get from margin over here is 31,500, divided by average operating assets, which again I could have gotten from turnover over here is 100,000. That also gets us to the end point of 31.5%. You may ask, well, why did I waste my time looking at margin and turnover? Well, one, on the exam, you're going to have to know how to calculate margin and turnover. And I think doing it this way, though, stresses that having a higher ROI or impacting ROI is the combination of being profitable. That's what our margins ultimately measuring, what's our profit per sales dollars, but also utilizing our assets wisely to generate our sales, which is what turnover is measuring. So now we're going to switch things around and start to understand if we make changes, how does that affect margin, turnover, and ROI overall? So let's look at our second situation here. The manager thinks they would be able to increase sales by 90,000. Well, ultimately, if you increase sales, you likely expect expenses also to increase, but profit overall is going to increase. And in this situation, profit or net operating income is expected to increase by 8,100. So assume we're able to do that without increasing our average operating assets in this situation. So what would be the new ROI? Again, I'm going to do it in terms of margin and turnover, same formula for margin, but this time our net operating income is the 31,500 plus the $8,100. Sales is 900,000 plus the 90,000. So now our margin is going to increase to be 4%. Turnover, same formula, but again, some of the numbers are changing. Sales again is increasing by 90,000, but we are not impacting our average operating assets, so they're going to stay as 100,000. So now our turnover went from 9 to 9.90. So actually margin and turnover have both increased as a result of increasing our sales. Our overall ROI is our margin of 4% times our turnover of 9.9, and we get an increasing ROI from the 31.5 to 39.60%. Again, I could have done ROI directly with our increased net operating income divided by our same average operating assets and still got the same 39.60. So if I assume all else is the same, I would actually want to do this increase to sales because it's overall increasing margin, turnover, and ROI. What about a completely independent situation? Assume you didn't have the sales opportunity. This manager says, well, I could actually reduce expenses. And a lot of times when managers are thinking about how can I improve my profitability, they look first a lot of times to say, how do I cut costs? This manager says, I can cut costs or expenses by $3,600. Again, assume the sales didn't happen. How would that affect margin and turnover? Same formula for margin, but this time we're going to start with our net operating income of $31,500. And because expenses are decreasing, that's the same thing as saying we're going to increase net operating income because our expenses reduce. We're going to add that 3,600 to that 31,500. Sales stay exactly the same as 900,000, and our margin is going to increase to 3.9%. Turnover, sales divided by average operating assets, and it has no impact. If we are reducing expenses, it's not impacting our sales, it's not impacting our average operating assets. We're still utilizing our assets the same, so no impact there. ROI is the margin of 3.9%. Again, that's an increase, times the same turnover of 9, 35.1%. So again, better than the first situation, and we'll compare at the end, but not as good as the second situation. So and again, just proven out, we could have taken our net operating income divided by our turnover to get the same 35.1%. What if I have another situation? And what if we assume that the manager of the club is able to reduce average operating assets? So I'm not increasing sales, I'm not reducing expenses, I'm saying those overall assets, whether it be, idle inventory that's sitting around, extra plant and equipment that we honestly really don't need. What if we do that without any change in sales or net operating income? And let's look at it in terms of margin. And margin would be the same net operating income divided by the same sales because we've not impacted those. So it would stay the same as the first situation, 3.5%. Where we're going to have a change is turnover. And same sales of 900,000, but this time we're reducing average operating assets by 40,000. So we're going to take the 100,000 minus 40,000. So 900,000 divided by 60,000 is going to be 15. Wow, that is a huge increase from where we started from. And we'll see our ROI now is going to go to 3.5% times 15. We went from 30-something% ROI to now 52.5%. That's a huge bump up in our overall profitability here. Again, just proving out that I could take my net operating income of $31,500 divided by my revised net average operating assets of $60,000 and also get the same ROI of 52.50%. So also impacting average operating assets is going to affect ROI overall. So this last part is not a required part of the problem, but I want to do this again so that you have a better conceptual understanding of how these different impacts are affecting margin and turnover. Again, starting point 3.5% margin, turnover of 9, ROI of 31.5%. If we increase sales, which also is going to increase our profitability, we bump up our margin to 4%, and we also bump up our turnover because our sales are increasing without affecting our average operating assets. And so we increase our ROI pretty significantly here overall. Reducing our expenses also has the overall impact of increasing ROI from the initial state. While it doesn't impact turnover overall, it impacts margin because our net operating income is increasing. Our fourth situation, reducing the average operating assets, had no impact on margin overall, not impacting sales, not impacting net operating income, but huge impact of turnover because I've got less assets generating the same sales. So in this situation, based on the numbers that we used, it's actually the best of the four situations to use. So again, overall conceptually understand how things like increases in sales, reductions in expenses, and reductions in average operating assets, how those affect individually margin and turnover, and how they affect ROI overall.